What if the Federal Reserve Chairman of the United States goes on television and says, "We're going to crush inflation. Zero tolerance, no mercy"? The moment the market hears that, traders immediately start thinking, interest rates are going up. Because if the Fed is serious about crushing inflation, the obvious assumption is higher rates. But what if the plan behind the scenes is actually the opposite? What if rates aren't being prepared to go higher, but lower? And if that plan works, this wouldn't just be another rate cut. It could become a full economic reset. The impact could reach everything from stocks to bonds, mortgages, the dollar, and precious metals like gold and silver. Because think about it. What happens when a central bank publicly appears to be fighting inflation, but at the same time moves toward cheaper money and potentially changes how inflation itself is measured? Who wins and who loses? Today, I'm going to break down what may be happening between the Trump administration and Fed Chairman Kevin Warsh, why the United States may struggle to afford higher interest rates, and the three-step playbook that could push rates lower and potentially trigger a major economic boom. And stay until the end, because I'll explain what this could mean for gold, silver, and copper. Let's get started. Americans are frustrated with inflation, and it's easy to understand why. Over the past 5 years, prices have risen dramatically while many incomes have struggled to keep up. The math is simple. If prices double and your income also doubles, your purchasing power may stay relatively balanced. But if prices rise much faster than your income, everyday life becomes more expensive. That frustration has led many people to compare today's environment with the inflation crisis of the 1970s. Back then, the United States faced a dangerous combination of high inflation and weak economic growth. That combination became known as stagflation. So naturally, people are asking, are we seeing the beginning of another 1970s-style problem? Recent inflation data has provided some relief. Inflation reportedly fell from around 4.2% to 3.5% between May and June, while some categories even saw actual month-over-month price declines. But there's a catch. A significant part of that relief came from energy prices. And if energy prices rise again, some of that improvement could disappear. So the real question is, what does the Fed do next? That brings us to Kevin Warsh. Warsh has emphasized the importance of price stability and fighting inflation. Sounds like a classic inflation-fighting Fed, right? Higher inflation? Raise rates. Lower inflation? Maybe eventually cut them. But here's where things get interesting. Because the public message and what could potentially happen behind the scenes may not be the same thing. And one of the biggest clues is coming from the bond market. If you want to understand what investors actually expect from the economy, don't just listen to speeches. Watch where the money is moving. When inflation came in cooler than expected, investors started changing their expectations. Short-term Treasury bonds became more attractive because traders began expecting that the Fed might not become more aggressive. Bond prices increased, and short-term yields moved lower. But farther out on the yield curve, the story looked very different. 2-year, 10-year, 20-year, and 30-year yields remained under pressure. And that matters, because the United States has a massive debt burden. America is already paying more than $1 trillion a year in interest costs. And if long-term borrowing costs remain high, that bill becomes even harder to manage. That's why the 10-year Treasury yield is so important. It influences mortgage rates, business borrowing, consumer loans, and the government's own financing costs. So if the administration wants lower borrowing costs, the question becomes, how do you bring long-term yields down? And this is where the three-step theory begins. The first potential step is changing how inflation is measured and interpreted. The theory is simple. If official inflation data eventually shows that inflation is already close to the Fed's target, it becomes much easier to justify rate cuts. There are already alternative inflation measurements such as trueflation that can produce numbers different from official CPI. So imagine this scenario. The official methodology changes. The new data shows inflation is much closer to the Fed's target. Suddenly, the central bank can say, inflation is under control, and that creates political and economic room for lower rates. Publicly, the Fed can remain committed to price stability. But if inflation is officially declared close enough to target, rate cuts become much easier to defend. Genius or dangerous? You decide. The second step involves banking regulation. One important rule is the Supplementary Leverage Ratio, or SLAR. This regulation affects how much leverage banks can use and can influence how much capacity they have to hold assets such as U.S. Treasuries. Now imagine regulators ease some of these constraints. Banks could gain additional capacity to purchase Treasury securities. What happens then? More demand for Treasuries can push bond prices higher. And when bond prices rise, yields generally move lower. That could help bring down the 10-year Treasury yield without the Fed directly controlling the long-term rate. And remember, lower long-term yields can eventually mean lower borrowing costs throughout the economy. That brings us to step 3. If banks suddenly have more lending capacity, that money can move into the private economy. Businesses could refinance expensive debt. Companies could invest more. They could hire, build factories, expand production, and potentially increase productivity. This is different from the emergency stimulus environment of 2020. Back then, enormous amounts of government support entered the economy very quickly. This time, the mechanism would be more heavily based on bank lending. Banks generally expect borrowers to repay their loans with interest. So, at least in theory, credit flows toward businesses and projects that lenders believe can generate returns. And that gives us the potential formula: lower measured inflation, plus lower interest rates, plus greater bank lending capacity could create a powerful economic expansion. Stocks could benefit from cheaper capital and potentially stronger earnings. Bonds could benefit from falling yields. Businesses could benefit from cheaper financing. Consumers could benefit from lower borrowing costs. And the government could eventually benefit from lower refinancing costs. But there is another side to this story. Cheaper money isn't automatically good. If rates fall too quickly while inflation remains elevated, real interest rates can become negative, and that changes the behavior of investors. When cash and bonds provide weaker inflation-adjusted returns, investors often start looking for alternative stores of value. And that's where gold and silver become interesting. If nominal rates fall while inflation stays relatively high, gold could become more attractive. Silver could benefit from both monetary demand and industrial demand. And if easier credit creates a new wave of infrastructure and manufacturing investment, copper could also receive a boost. So this isn't just a story about interest rates, it's potentially a story about the entire financial system. Stocks, bonds, the dollar. Gold, silver, copper, and the cost of money itself. Now let's put the whole theory together. Step 1. Inflation gets measured differently, or the data shows inflation is close to target. Step 2. Banking restrictions are eased, giving banks more capacity to buy treasuries and lend. Step 3. Cheaper financing stimulates private sector borrowing and economic activity. If everything works exactly as supporters of this theory expect, the result could be a major economic boom. But there's a huge if. Because if inflation doesn't actually disappear, if borrowing grows too quickly, or if investors lose confidence in U.S. fiscal policy, the same strategy could create a completely different outcome. Instead of a smooth economic boom, you could get renewed inflation, asset bubbles, or even greater pressure on long-term Treasury yields. And that's the real question. Is this a smart economic reset, or a dangerous attempt to make debt cheaper? We don't know yet. But the market will be watching three things very closely: inflation, the 10-year Treasury yield, and bank lending. If all three start moving in the direction this theory predicts, the story becomes much more interesting. And if real interest rates move deeper into negative territory, don't be surprised if investors start paying even more attention to hard assets, especially gold, silver, and copper. So who could be the biggest winner? Stocks? Bonds? Gold? Silver? Copper? Or maybe different assets win at different stages of the cycle? That's the debate. And remember, this is not financial advice. It's analysis designed to help you understand a potentially important economic setup. So tell me in the comments, which asset do you think could benefit the most: stocks, bonds, or metals? If you learned something new, hit the like button, subscribe for more simple finance stories, and turn on the notification bell. I'm your friend Matthew. Take care, stay aware, and I'll see you in the next video.